All right. How's that?
Looks good to me.
I'm so sorry that I can't join you in person. I appreciate you offering it. It's just a weird year for me here with this move.
Yeah, hey, I'm grateful to have you in any capacity, virtual or in 3D, as some of my friends like to say. But I thought that we would just go over a couple of different things that I would be very interested in asking you if you and I were indeed just sitting around the fireside and having a chat. From your expertise, especially from your perspective, what overcoming what I think is everyone's biggest challenge, which is fear and mindset to start investing. And I think that that's even more prevalent amongst LP investors. You find GPs might be, I think, a little bit more risk of tolerant and a little more of the risk takers. And so I'd love to talk about that and what your thoughts are on it, and then also talk about the advantages of being an LP, and then outside of that, just really anything else that you want to talk about.
I'm honestly happy to talk about whatever you want to talk about. So, but the only thing I ask that we don't talk about, in fact, is just when I do these types of things, I avoid discussing my investor group. I want to avoid public solicitation. I don't have a website. I'm just really low risk with all this stuff. So you can definitely read my bio, which includes a mention of my group. But in terms of discussing my questions about group, the truth is I only send stuff I'm investing into my group. It's only a very small subset when I'm investing in. So it's all the same stuff. I just don't like a direct mention of the group. That's all.
And is there, so I did not intend to start with your bio, but usually I will invite an individual to do that because I think that you will do a much better job of it than I would, and make sure and say the things that you want covered. So we'll, if you want, I'll just kind of kick off and then just pass the baton to you for introduction.
Okay. Absolutely. And then also just a quick note as well, in terms of time, I have as much time as we need. And I'm hoping I can get a rain check for next year, because it sounds like you do a great conference. So assuming we're going on next summer, I'd like to come out there. So just keep that in mind if it makes sense for you.
Well, it absolutely does. And as I said in the email, your invitation will always be open.
Okay, thank you.
So, all right, so I'll try to kick it off here and do a halfway decent job in my best hillbilly voice. So,
and before you start, how long do you want this to be? Is there a certain target time?
I don't. I think that I'm aiming for a 30-minute. If you were in person, it would be 30 minutes.
Okay.
And because as opposed to the typical hour, the focus of this conference is going to be two things. Number one, the number one thing is networking, and that's usually the thing that most people are looking for the most out of these conferences, and the thing that many of them don't do anything to promote, the actual networking. And so that's the number one thing on my list, is to make sure that every person that comes to this event goes home with 600 names, email addresses, and phone numbers.
Wow.
I want them to have, I don't want them to be dependent only upon their own resources to collect 30 or 40 business cards and then go home and that's all they got. The really good people might get 30 or 40. The introverts and everyone else might come home with, 5, 10, 20. And so that's the number one thing. I want people to, I hear over and over again, the hardest thing in this business is raising capital. And the reason so many people struggle with it is they don't have anybody in their database. And so here we're going to give you, if you have no one in your database, we hope to send you home with 600 real estate investors. And so you're primed. You don't have to find out if they're an investor. You don't have to find out if they're interested in real estate. You just need to reach out and show them a good reason to invest in you and in your deal. So that's the number one thing that I'm aiming to accomplish. The second thing is I want to actually do deals at the conference and leading up to the conference. So I have been doing for my GOB network group I've been doing what we are calling the Goya 90-day challenge, which is we're trying to help promote networking amongst the group members to find 5 to 8 people that are willing to take down a small property together collectively. And I'm trying to do it in such a way that it's high leverage, so they don't have to raise a lot of capital to get it done. And we're trying to get them to get a small property under contract within 90 days. And then I want to repeat that every 90 days. So at the end of a year, I'd like for them to have 100 doors or so under contract. And then they can go out there and start trying to do what everybody tells them they need to be doing, which are these big deals. You know,
Right.
but I want them to build up to it slowly. And so we're going to try to promote doing deals and creating natural partnerships and networking. But so I think that key to that, that's why I want to ask you those particular questions, because fear of when you finally put a deal in front of someone, a lot of times they just can't move. They just don't feel like they have enough information. They just don't, you know, they can't get past the fear. They feel like they don't know enough. And so they just sit on the sidelines, because if you're one of those people, you'll never know enough, you know. And so that, and then the advantages of being an LP, because I think that, you know, you go to a lot of RIAs and meetups and conferences, and if you polled everyone in the room and said, how many here want to be a real estate investor? Well, then 100% pretty much going to raise their hand, or else they wouldn't be there. And then you say, well, how many of you have actually already invested in a deal? And my guess is half of the room will raise their hand, and the other half are still trying to get there. And so I think that, you know, a lot of them come to these meetups thinking that, okay, my path in is fix and flip or buy and hold. And that's what just about everyone thinks where they need to start. And that's really, and the reason I think a lot of them never get started is they have a W-2 job, they have a busy life, and they can't see themselves fixing and flipping,
Right.
or holding a property and having to wake up in the middle of the night and go fix the busted water heater.
Right.
And so they never get started. No one ever takes the time to say, have you thought about being an LP? That's the fastest, easiest way to become an investor. We could literally you or me walk in a room on any given day and turn everyone in the room that wasn't an investor into an investor that day. You know, and so that's, I think, some of the things that I'm hoping to uncover, or not uncover, to motivate people to take some action and say, oh, okay, I never thought of it that way. And I think, you know, with your years and years and years of experience, I'm just anxious to hear your take on those things. So
okay, great.
But
well, let me just make sure my ringer's off, just to be 100% sure. Yep, looks right. Okay, well, I am ready to go whenever you're ready.
All right, and it's very casual, Jeremy. If we go astray, it really doesn't matter.
Okay.
Because I really love, I think real conversations are the kind that make the most impact, and it fits my style anyway, because I'm not a great speaker, but I am a very curious individual. And I think that, you know, if it goes astray, don't worry about it. I'm not worried about it.
Okay, I'm not worried about this at all.
Okay, fantastic. So I want to say thank you so much to Mr. Jeremy Roll, whom I consider to be one of those legendary investors. One of the people that I met quite a few years ago. Him and I shared a passion for automobiles, and we had some strange automobiles that we had in common, actually, for collecting back in the day. But Jeremy has a tremendous amount of experience in the industry, been doing it for a long time, and we're just so pleased to have him at the GOB Network Conference 2 as a special guest for everyone who's attending virtually. This is extra content that only you get to see. And so, Jeremy, thank you very much for being here. And if there's anyone that hasn't met you before and doesn't know who you are, and I can't imagine that, but would you just introduce yourself a little bit and tell us a little bit about Jeremy Rowe.
Absolutely, and thanks for having me on here. I hope this is helpful for everybody who is attending and listening to us here. Before I even get into my intro, I just want to thank Jim for having me, and also want to say that I am not a financial advisor, investment advisor, accountant, or attorney, or anything like that. So anything you hear from me today, just my perspective as a passive investor. So I'll try to give you the short version of my background and kind of make it more applicable to what we're going to be talking about today. So I'm originally from Montreal, Canada, moved down to the US in the year 98, did an MBA over at the Wharton School, University of Pennsylvania back in 98 to 2000. I have a total of about 10 plus years of corporate world experience. My last two jobs were at Disney headquarters in LA, where I live currently, and Toyota headquarters. My last job, Toyota headquarters, ended in mid 2007. And I went down the passive investing path as an LP investor starting in 2002 after the dot-com crash. The whole genesis for me was I was sick and tired of the volatility and the lack of predictability of the stock market for my long-term 10, 20, 30, 40-year retirement account. And so I was looking for more predictable returns, and and cash flow ended up being my focus for that. And so I started rotating my money from stocks and bonds into cash flow in 2002 with the real estate syndication. And I ended up basically leaving the corporate world in 2007 from the cash flow. So I've been an LP investor for, it's going to be actually 20 years in February of 2022. And it's going to be 15 years full-time as of June in 2022. So I've a whole number of years of experience now as an LP investor. I do this full-time. A lot of networking is involved. And I also manage a large investor group. And I'm also an advisor for Realty Mogul. And I don't want to go on and on, but I do a whole bunch of different things. So thanks again for having me here.
So I'm really curious, Jeremy. We have so many people in the business that want to be GPs. Even I think a lot of the LP investors are just chomping at the bit to be a general partner. And you've chose to do it in a different way. Can you speak to that and why you chose to be a passive investor?
Yeah, absolutely. That's an easy one for me because when I was looking for different ways to invest, and I came across the concept of cash flow, the immediate need for me was being passive because I was working at Disney headquarters. I was crazy busy. I mean, I was the guy on the cell phone in the elevator in between meetings, and they weren't even paying for my cell phone plan, but I was still doing it because I was just juggling too many things. So for me, the concept of being active, not only did I have no knowledge about it, but the concept of it in general, in terms of time, just wasn't an option. So I by default started to look at the passive side. And what's interesting is that I'm still passive today, 20 years later, because as it turned out, it's a really good fit for me. It's not the right fit for everybody, but it was a very good fit for me.
People are surprised. Oftentimes I will say that, some of these deals, as we get longer into the cycle, and that I focus primarily on multifamily, and you've been on the sidelines for a while on multifamily and have been investing in some alternative assets. But, the deals, when we go from a 70-30 split to a 75-25 or an 80-20 or even some 90-10s that I've seen, as a GP, oftentimes you're doing a tremendous amount of work and you're making very, very little for all the extra work that you're doing because you have a responsibility to your investors and they have expectations for certain returns. And oftentimes you have to wait to the very end to get paid at all as a GP. And everyone is surprised to hear me say that, because I don't think most GPs are actually espousing that or sharing that with a lot of the LPs that are out there. But we talked a little bit earlier about what I believe is the easiest, fastest path to becoming a real estate investor. So if you're sitting on the sidelines and looking for the fastest way, I want to get your take on that. How do you feel about what it means to get off the sidelines and an easier way to get started?
Yeah, and Jim and I were talking before we started recording this, and essentially we both agreed that the easiest way to get started is to be a passive or limited partner investor, where you're pooled amongst a lot of different investors in something called a syndication. The pure, simple answer to that is versus someone who I call active, and some people wouldn't consider this active, but I call someone active. To me, I delineate it based on control. So as a passive investor, I give up control for diversification across asset classes, geographies, and operators. That's my opinion. And being active means you can own a rental home and hire a third-party property manager and tell me that you're passive. But the fact of the matter is you have control. You have the ability to hire and fire a property manager, and you have the responsibility to do that sometimes. You have the ability to refinance anytime you want. You have the ability to sell it anytime you want. You have to make decisions about when the toilet's being changed, which model you want, and how much you want to spend on it, and on and on and on. So that's where I delineate active versus passive. To me, when I'm as a passive investor, all the work I do is upfront. What I mean by that is I do all my due diligence on the operator and the opportunity upfront. And then once I make that decision to move forward, after that, all the onus is on the operator to perform, send me typically quarterly reports and checks for cash flow type investing. Sometimes it's monthly. And I will track and monitor that, but literally after all that upfront work, I'm not doing any more work. I'm just waiting for reporting from someone. It's almost like they're reporting to me, right? So it's a totally different level of work, a much easier way to go about things, in my opinion. And you can get access to deals probably a lot more easily without even having to build a network to an extent than trying to do something actively, right? Actively, you got to go build a network of agents, find properties, try to find the better deals, which can take a long time. Passive investing, if you want to take it at the simplest level, if you're an accredited investor, you can go on tonight in your pajamas, log on to a crowdfunding portal or 10 and download literally 20 or 30 apartment deals in an hour or two, and it literally decided to invest in 5 of them within a day. Now, I'm not telling anyone to rush into it. I'm just saying the ease of which, the hurdle that's, the lack of hurdles to be able to do that these days with technology, it's much, much easier to get started that way.
Yeah, I appreciate you've named some of the really good reasons why you should be a passive investor or an LP. And I find that, when we started this GOB network, we have so many people coming and they want to learn so many different things about how to build relationships with brokers and how to build relationships with sponsors and with lenders. And it just runs the gamut of the amount of information that they need to learn. And I love the fact that you said one of the reasons to be an LP is you can shortcut all of that, overcome all of those obstacles just by being an LP investor. And so I'm curious, are there any other advantages that you can think of being an LP?
I think one of the biggest advantages for someone like me, and of course, there's 1,000 ways to invest, none of them are wrong. So I have a very specific way that I invest personally, and it's got to be the right fit for whoever's considering it. But the diversification to me is really the big deal. I mean, I am biased because I'm in over 60 LLCs right now. I've been in over 150 to 200 over time, the past 20 years. But just knowing that I can be in many different apartment buildings in many different areas of the US, even student housing apartment that I'm in, regular apartments, I'm in tax abatement deals, I'm in low income tax credit apartment deals, just apartments. Forget about mobile home park, self-storage, RV park, industrial, retail, office. I mean, I'm in all of those and some other stuff too, right? Just those 4 types of apartment deals. In order for you to learn how to actually actively purchase any of those, that would be an immense amount of learning all separately. Then, of course, the amount of capital required for you to co-invest or invest on your own to buy a building of any substantial tenant diversification size is completely incomparable between the two, right? I'm able to actually put money across a lot more things, and it's smaller chunks of money than buying a single building directly. I don't have to have the credit. I mean, there's so many reasons why, the diversification is, to me, it's a huge, and again, going back, it's very important. I try to diversify across asset classes, geographies, and operators, right? There's potential issues with all 3, but because I can put small pieces across a lot of deals, I'm able to do that across. I think I've personally been invested in some form or another, and some funds are invested in multiple states, in over 43 states, essentially, over the last 20 years. I mean, imagine trying to do that actively just to get diversification across a bunch of economies. It's unless you build up a huge organization, it's practically impossible. So the diversification aspect is probably the #1 thing for me because I'm a low risk person and I love the concept of being really diversified.
Yeah, that's wonderful. So there are some limiting factors in becoming an LP or becoming an investor, period. What would you say are some of the biggest things holding people back?
Yeah, #1 is to be an LP means you have capital to invest, right? because there are ways to do things actively, whether you're wholesaling deals or using other people's money where you don't actually have to have the capital yourself. So that's a definite limitation. I'd say the next biggest limitation is being an accredited versus non-accredited investor. I actually spoke to a couple of non-accredited investors in the last couple of days, and the first thing I say to them is, look, you can invest if you like, but your options are much more limited than an accredited investor for this type of investing, right? And then I try to help them to brainstorm what to do. And funny enough, one of my two major suggestions for at the moment for a non-accredited investor is to look at publicly traded REITs with dividend distributions, right? Especially because the stock market's down and they're on sale, and the dividends are probably going to be similar. So that means your percentage actual dividend is higher at your lower basis. So being an accredited, if you're not an accredited investor and you want to be a passive investor, it's going to be a much harder hurdle to overcome. I started as a non-accredited myself, but times were very different 20 years ago. Much larger percentage of the opportunities took on non-accredited investors back then versus now for a myriad of reasons, which we can get into or not. But and so that's definitely a hurdle. Another hurdle is, of course, I made the comment before about logging in your pajamas and downloading 20 deals. The fact of the matter is you're not going to invest something you don't understand. So you're going to want to go and learn everything, right? So it's not necessarily compared to being active. Both of them have learning hurdles. It's just a different type of learning. But you do need to get very familiar with what you're planning on investing in. And along the lines of diversification, it does take a long time to diversify properly if you're being careful about the types of deals you're going into and who you're investing with, but also learning the asset classes properly, right? I always tell someone, if you're brand new, start with one asset class, focus on it, and then learn it really well, try it a little bit, and then you can apply like 80% of those learnings to all the other asset classes with some tweaks, which is one of the great things about this type of real estate investing. But you do have to go down the path of learning things properly, not just jumping in completely blind. So there will be a lot of learning involved, but that can be very useful and very transferable along to other asset classes in the future. So, those are some of the easy ones coming to mind. Networking is a key piece of this as well. Jim and I spoke about this before we started recording. I mean, one of the number of things I do all day long as a passive investor is network. I can't think of a deal that I found that I didn't find somehow networking, whether it's I found the sponsor directly, whether it's another investor referred me to that deal, whether it's I went to a conference and met a bunch of people and found a deal. It's all about the networking. So I would say that if you don't like the idea of networking, you don't have the time to network or the interest in networking, your ability to diversify as a passive investor is going to be very limited. And that will create a hurdle for you to really have a diversified portfolio. You can get around that a little bit by going onto crowdfunding sites, get access to a bunch of deals, but those have pros and cons themselves being on the crowdfunding sites, right? So those are some of the things to consider for sure that are more the challenges associated with being a limited partner investor or passive investor.
Yeah, I'm glad you brought up several of those things. Some of those hurdles, if we want to call them that, are the several of the reasons why we started the GOB network. Was to be able to have that idea of a crowdsourced hive mind Wikipedia type idea. And it's why we decided to begin as a nonprofit, because we don't want the education to stand in the way of people becoming investors. And I think that that's a huge hurdle for a lot of people, is the knowledge is available in a lot of different places. And, the GOB network is just striving to make it one of the most accessible, easiest ways to do that. Because I agree 100% in you need to be an educated investor. But then I also want to juxtapose that against the average investor, not the average real estate investor, but the average stock market investor, and how much they actually learn about the stock that they're about to invest in before they do. How much do they really know? How much do they understand of the financials? How often are they receiving the financials and the updates? And what impact can they have on that investment? And so I'd love for you to speak to that just a little bit.
Great point. So that's something I've never thought about, because I haven't invested in stock. I haven't had publicly traded stocks like that since 2007. That's when I had rotated everything out. But what's interesting about passive investing is, some people are probably even surprised for me to hear this, but as someone who is just trying to find the best opportunities, in fact, the number one thing that I focus on is not the actual property itself. It's the person I'm making a bet on. And one of the benefits of this type of investing is that you could do due diligence on who you're making a bet on, get to know them directly, right? If you're investing in a publicly traded company, let's take Apple. How many tens or hundreds of thousands of employees are there? Can you ever talk to Tim Cook and understand what his vision really is? No, for sure not. Can you even understand the CFO, the CEO, or those people that you want to make bets on? These are not realistic possibilities. You actually have all that opportunity on the passive side here, on the real estate side. And I would argue that I'd rather invest with, for example, the best operator with the worst documents, right, in terms of a presentation, than the worst operator with the best documents and the fanciest put together presentation, right? And you're going to want to judge whether someone's aligned with you from a conservative perspective, from a mindset strategy perspective, but you get the opportunity to do all these things before you actually move forward. And I tell you that who you're making a bet on, in my opinion, is more important than the property, with the property being a close second. The easy example I can give everybody, just so they can understand this, is, you can invest in the best property in Beverly Hills on the Main Street Rodeo Drive that's 100% occupied in 2000, and like at any time, and it gets run down by the operator, and they don't, run it well and operate it well. It's going to end up foreclosed, keys back to the bank. You've lost all your equity. You can also invest with, the best operator in the worst area, for example, and they can, perform brilliantly on adding value to a property that was maybe even, like, forget Beverly Hills, it could be in a C area, a C property. And if they're executing well, you can potentially make quite a lot of money. So the outcome is very dependent on who you're making a bet on. Even I would say, look, you're better positioned, you're positioned in a certain way if you're investing in 100% occupied property in a really strong growth market that's been managed well up till that point. But if it's mismanaged, again, there's going to be major problems. So I would urge people to focus on who they're making a bet on as a first priority. And that's very different than a publicly traded stock, because often what people do with a publicly traded stock is they'll get the financials, the annual, the quarterly reports, and they'll just look at the numbers. Are they growing? Are they managing the cash well? All these numbers that they're looking at, right? But they're not understanding who it is that they're making a bet on necessarily, the personality. Are they conservative? What types of decision? Why did they even choose this exact property? What was their thought process behind it? You get down to the nitty gritty of that by talking to the people directly. So it's a very different way of investing. I love the fact that I'm able to really get down to the nitty gritty of trying to figure out who I should make a bet on. Once you develop, you have more experience doing that, and you develop the skills, you increase your probability significantly by having a little bit more, I would call it, you're kind of able to have more control over the outcome, because you're really actively making a choice on who to make a bet on.
Yeah, and again, I like to use the analogy of Google, who I do invest in, and also with Apple, but I can't call anyone at Google and say, look, I don't think the colors are right today. I think we need to change the color or change the font. But you can do those types of things in an apartment complex. It's called forced appreciation. And one of the other beautiful things is it's one of the many ways to make money in real estate. And when we're buying a stock, we're really, for most stocks, just buying one way. And we're hoping on appreciation. And we always tell people in real estate, look, that's the last thing you want to bet on. It's just a cherry on top. Yes. And yet the other investments we're making, that's really the number one thing we're betting on.
And the worst part about it is that these publicly traded companies, take Google or take Apple. Apple's a great example. What are they coming out with in 2 or 3 years, Jim, when you make a bet on them today? Do you know?
I have no idea.
It's completely secretive. And so if you want to make a long-term bet on this company and you want to actually bet on the upside, but you don't actually know their business plan, that's a pretty big roll of dice, right? But when you invest in a property, before you get into it, I would argue you better understand the 5 or 10 year business plan, exactly what they're planning to do, how they're going to execute on it, the budget that's going to go behind it, and whether or not you agree with it, right? And now all of a sudden you're making a very well-educated 5 or 10 year or maybe shorter term bet on an entire plan and an entire set of people, versus where is Google going to make it? What are they going to do in 2 years? Are they going to pivot? You have no clue, because it's frankly kept secret on purpose for competitive reasons. So it's just a different way of investing.
Yeah, absolutely. And I think one of, I don't remember who I heard it from, but on a risk adjusted basis, I think, investing in real estate is probably not only one of the safest, but also one of the best returns, risk-adjusted returns that you can make. And I'm glad that you brought up the REITs, because people believe that they can't invest in real estate if they don't have 25, 50, 100 grand. And it is getting harder in private placement deals to get into deals because of the barrier to entry with the dollar amounts. And I really believe that if you have the opportunity to change someone's mindset and to get them started investing very early in life, when they're on their first job behind the counter, flipping burgers, whatever that is, if they can invest then, even in something like a REIT, where there's not that big, huge barrier to entry, and have that benefit of investing in that risk-adjusted real estate piece, I think that that's a wonderful way to get in if you're a real financially constrained in trying to get in. I think one of the other ways potentially would be to have a Reg A plus type of offering.
Yeah, crowdfunding.
And that's one of the things that we're looking at very strongly as one of our goals, is because we're on a mission to bring financial literacy to as many corners of this world, of this United States, as we can. And one of our big long-term goals in doing that. And so I really appreciate you bringing this vast amount of knowledge. I want to pivot for just a second and talk about something that's different, something that I've heard described as the longest, most difficult journey that you'll ever take in your life, and then get your perspective on that. Have you heard that expression before?
No, but I was trying to come up with some snarky joke about that, but I'm not a comedian, so I'll just let you do the speaking.
Well, they say that journey is only 6 inches, and it's from here to here. And so if you are just listening, it's the 6 inches between your ears. And so I know a lot of people, depending upon their personality, would have a lot of reasons, and or some people would say excuses, not to invest. It obviously, I don't know if it ever was a problem, if any of these things were a problem for you, and if they were, how did you overcome them? Or if not, can you speak to how to overcome them?
Yeah, so in my particular case, and it's obviously a great topic and a great question, my particular case, I was very lucky, because the first people I started investing with were lifelong friends of my family who I had grown up with. I knew since I was 4 years old. I played street hockey with their kids, and I knew I could trust them. And also I knew I'd be able to learn from them in a much deeper way than a typical syndicator I could invest with. So for me, that hurdle was much easier to overcome than a typical person, I think, to be fair. I will say that, I co-founded something called For Investors by Investors, FIBI, back in 2007. It's a nonprofit public meetings where do you go in person? This is mostly in Southern California, where there won't be any sales pitches. That was our big thing, because I just wanted to help people avoid the sales pitches I had to be exposed to all the years and all the networking I did. And I have seen many people come to our meetings, listen to panels for years, and not actually deploy any capital. And what I would say is that, number one of the helpful things you could do to avoid that is to, rather than worry about which asset, like a lot of people get distracted by a whole bunch of asset classes. So they'll go to a meeting and they'll listen about self-storage. They go to another meeting, mobile home park, then you got apartments, and then they're listen to industrial. And by the time they're done, in all fairness to them, they don't know where to start, right? They don't know what's best for them. And so I always tell people, just try to avoid the noise. The easiest way to get started is to start with an asset class you understand best, okay? Frankly, apartments is the most common one that people start with, because they've lived in an apartment at some point, most likely. They understand the business model, and it's actually a more straightforward business model than some of the other asset classes in some cases. And what I like about it best is that, think about how many self-storage facilities there are for every apartment building in a big city, right? Very few. Obviously, there's a lot more apartments. So that means you're going to have access to a lot more apartment deals. Just as a starting point to be able to find deals, right? It's going to be easier. So there's a lot of reasons why that particular asset class is chosen. But what I tell people is, if you grew up in a mobile home park and you understand that business model, start with mobile home parks. Just don't make it any more complicated than it needs to be. You already understand how they work. and try to keep laser focused, learn the basics of that, whether it's exposing yourself to speakers, panelists, podcasts, educational pieces. Jim mentioned there's a lot of stuff out there, courses, etc. Dip your toe in a few of those. And I think what's going to happen is that by focusing on one asset class, instead of getting worried about what you're not investing in, you're focused on what you are investing in. And then you've learned so much that you'll have the confidence to take that information and transfer it to those other asset classes we talked about, right? And so I think that a lot of people who end up not moving forward, sometimes it's a lack of confidence and a lack of full understanding because they've tried to learn too many things at once. So that's my number one recommendation on how to avoid not getting started, even though you've been trying for a long time. And by the way, I'm not pointing a finger at those people. A lot of them put a lot of effort into going to a lot of meetings, put a lot of time in, drive a lot of hours in traffic, and are trying to do the right thing. But ultimately, I think that that focus is absolutely key. And the great thing about today's technology, compared especially when I started, is that, again, you can find a lot of these resources while you're driving. You can listen to podcasts, you can watch virtual conferences like this. You can get all types of books and education downloaded, right on your computer, and you can find opportunities in your pajamas. So it's a great time to be trying to figure all this out in terms of technology.
Yeah, I love that you brought up the point that you know a lot about certain asset classes just based upon how you grew up.
Yes.
If you grew up living in apartments, if you grew up living in a mobile home park, whatever that looked like for you, you've got a huge advantage that when I bought Apple stock or I bought, trying to buy an old school dividend stock like Clorox, I don't know their business model. I don't know what they do. I don't, the best I can hope for is I like Google and I use Google, so I'm going to buy some Google. But
Right.
You don't understand it the way you understand an apartment building. You know who the tenant is. You know how they're going to get there. It's just, there's a lot of pieces, a lot of moving pieces that you already know a lot about.
Yeah.
And I think that that's a huge leg up. And so I know that, let's talk about fear a little bit. Did you ever suffer from fear when you made, I know you said that you invested with some close family and friends in the beginning,
Yes.
but when you switched asset classes the first time, was there a fear hurdle to overcome? And if so, how did you navigate that?
Yeah, great question. So when I started with that family that I mentioned, they were investing in retail and office. So I got to learn two different asset classes quite easily with them. And actually a lot of it's transferable between the two, but they're different for sure. The way I learned, I then pivoted to do something else, like whether it was mobile home parks, apartments and whatever I was looking at the beginning, was through a lot of education. I am a very detail-oriented guy. For everybody who knows me, that they know that that's my reputation, and it's true. And so it took a lot of education for me. Now, back in the 2000s, when I was learning all this to start, I had to go to in-person meetings, and I was going to an average. I didn't have kids at that point, and I was going to 2 to 3 meetings a week in LA. And luckily for me, I was in a large city that had a lot of meetings, right? Because if I was in the middle of Minnesota, no offense to anyone from Minnesota, there wouldn't be that selection of meetings for me to go to. So I spent a lot of in-person time listening to speakers, panelists, learning the asset classes like that. That's actually the majority of how I learned. And then once I had enough information and got enough confidence to then know that I was understanding what I was looking at, I would then try that new asset class. I want to actually make a point, which is interesting, because now that we're talking about this fear topic, there's a deal I was looking at in the past few weeks, and I decided not to move forward on it. I just sent a note to the sponsor, okay? And it was a gut feeling, like, I want to do this, but my gut is telling me no. And I know why it was telling me no. We can get into it if you want. But the point is that there's fear of moving forward, and there's also your gut telling you not to do a deal, right? When you kind of want to do it. I would always tell you in this type of investing to listen to your gut and in general life, but I'm a big believer in that, because that held me back from doing a deal that probably wasn't the best fit for me, even though I wanted to do it. So it's similar. That's not really fear, that's your gut, but your gut's telling you something, right? And of course, I also never recommend someone move forward unless they're 100% comfortable doing so. And for me, the way I got 100% comfortable way back when was to educate myself as much as possible before moving forward.
You just brought up something that's going to cause me to pivot again, a different aspect. And one of the reasons they say this is one of the, not just the longest, but toughest roads you'll travel, is there's not just one thing to prevent you in that the mindset, that interior little person sitting on your shoulder. So let's talk about a different one, which is the perfectionist. And I want to ask you a different way. What asset class have you invested the most in, and the one that you feel you know the most about?
Good Lord. At this point, I mean, the ones coming to mind that I've done the most in are probably apartments and mobile home parks, just off top of my mind. I couldn't tell you statistically if that's actually accurate, but it's the one coming to mind.
We'll trust your gut.
Yeah, but yes, but again, I'm in so many different things that, you know, at this point, I'm very comfortable in most of them, honestly, except for hotels are one I can tell you I haven't done purposely, so I'm not comfortable in that one.
So let's take apartments and mobile home parks. You're very comfortable. You've made thousands of investments. Do you feel like you know everything there is to know about apartments or mobile home parks, or is there things that you're still learning every day?
No, absolutely. And in fact, you know, I want to point, this is a very good topic, because what I tell people is you're trying to make a bet on someone who's very experienced and understands every single angle of the asset class. And your job is not to understand every single angle of the asset class. I'm telling you right now, because that's an active investor. That's not my job. My job is to assess the person I'm making a bet on, assess the high level characteristics of the property, assess the pro forma, and see if I agree with the assumptions. But it's a trust but verify, right? So the verified piece is all this assessing. And at the end of the day, when you give your money to somebody and you're giving them control, you're giving them your trust, right? But you have to verify. But I'm going to tell you right now, Jim, if you gave me the keys to a 100-unit apartment, I've invested in, I don't know how, I've invested in probably 10 apartment buildings in the last year that were very unique deals, tax abatement deals and stuff. But the point is that I don't know how many total I've invested in, okay, over 20 years. But if you gave me the keys to an apartment building, 100 units, and said, good luck, like, go run this, I literally wouldn't even know where to start. I couldn't even tell you the first thing I should do. Like, I mean, I'd imagine maybe a condition report by some, I don't even know who to hire. So that's where you're giving, you know, all that work to somebody else who's the expert, and you have to trust that expert. So yeah, it's there. I actually probably know maybe 10% or 20% of what's truly involved, because if the carpet has to be replaced, I have no idea what type it should be, where I would buy it from, who I should hire to do it, what type of glue should be used, why it's cheaper to do a different type of, I have no idea, you know? So I don't know if that's what you had in mind, but yeah, that's a very important point.
Yeah, because I think that if you're a very analytical person, you want to learn as much as you can about underwriting the deal. And that becomes very important for you. But you can get, what do they call it? Paralysis by analysis.
Analysis paralysis, yeah.
Yeah, and that can be another thing in that 6-inch journey that you're trying to overcome. I'm trying to think, those are the two biggest ones that come to my mind, are fear and analysis paralysis. Anything else come to your mind in trying to get started?
Well, I'm going to touch upon a slightly different angle of that. So I think that I talk to a lot of new people all the time just to try to help them, and they're sorting out what to do. And the one thing I would caution people of is, actually, the true story, I spoke to someone last week who was a metal worker who won $1 million on DraftKings. Okay. And he said to me, I was a millionaire for 8 days and I paid taxes, and now I've lost half of it. Right. That was his thing. But to his credit, he has no idea where to start. This man has never invested before, has never had the funds to invest, and he's being really careful. So I love the fact that he's being careful and really researching. So the first thing I said to him was, well, okay, you got all this money and you want to put it to work, but is the timing right? Now, it doesn't mean that just because you've got the money, it's the right time to invest, right? So the first thing you need to do is understand the market a little better, understand the economy a little bit better, and come to the conclusion as to whether the timing is right as an investor, not as someone who just got $500,000 because you just happen to get it today, right? And I want to just caution people that I talk to people all the time who have built up some savings and maybe say, okay, I want to invest across X number of deals and get out of the corporate world in Y number of years. And here's my plan. And I want to start today because now I have the capital. My first question back is this the right timing for you to start? You have to make that decision, right? That's very subjective. But a lot of people take that first step because of the capital that was the push. but they haven't necessarily considered the market timing. And this is a great time for me to be mentioning this. I would tell this to anybody at any time, but we're recording this in 2022. We got inflation, we got interest rates up 250 basis points. We have a war. We have, housing market cooling. We have a potential recession coming up. Is this the right time to invest for you? The answer could very well be yes, but could also maybe be no if you start thinking about that. Maybe I should wait 6 to 12 months or 18 months. So everything moves in cycles. Real estate is no exception. And of course, in retrospective, I say to you, Jim, should you start it in 2007 or 8 or maybe 2010? There's a very simple answer for that. We all know the answer. But at that time, just because you got the money in 2007, it didn't mean that's exactly what you should do with it at that time. So please do consider market timing, the cycles. And if you don't understand that or aren't familiar with it, make sure you learn it so that it's not just about learning how to get into a deal. It's about making sure that you have the education and knowledge to know if it's the right time to even start.
Yeah, and I think that everyone can get a world-class education nowadays. Not to toot our own horn, but we've tried to aggregate as much data in one spot and as many professionals in one spot as we can. And we're still in the very early stages of doing that and laying the foundation for it. But that's why I'm so grateful to have you speak to the GOB network, Jeremy, and can't say how much I appreciate the depth of knowledge that you bring, and to let everyone know that visiting virtually this year, that next year we're hoping that the stars line up and that we're able to get Jeremy in person. But you guys are very, very, very lucky because you're the only ones getting to hear this from a legend, I think, in passive investing, and that if Jeremy can get there, I think that we all can get there. Maybe not as efficiently, maybe not as fast, but if we start early enough and if we discipline ourselves and we continue to educate ourselves and be a lifelong learner, then I think we can all get there. And I'll let you take us out, Jeremy, and just have the final word.
Yeah, I mean, to anyone who's new out there, really, there is no difference between me and you. The difference is time, okay? And time and effort, right? I put a lot of effort in over a long period of time, and now I'm in a different position than someone who's starting. But I was brand new at some point, not knowing what the hell this was or what to do. And so really, it's just a question of focus, effort, and time. This type of investing is typically a long-term mindset. This is not a get-rich-quick type of investing whatsoever. It's the exact opposite. But if you're able to treat it that way, learn, take advantage of all the resources on GOB and other places that you can find. This is an interesting path to go down if you have the long-term mindset. That's absolutely key in this type of investing. So that's about probably the best parting words I can give, I think. But I hope this is helpful for everybody. And thanks again for having me on. Thank
you again, Jeremy. It's a real pleasure.
Thanks, Jim.
That was great, Jeremy. I think there's a ton of value there. A ton of value.
I was a little concerned because every time I do something like this, it goes longer than everyone expects because I always have a ton of information to share. And I hope that it's okay because I think, what do we do, about 40, 45?
Yeah, I think we started at 10 after, I think, and it's 50.
Yeah.
So
are you going to cut it down or you don't have to do that?
No, I won't need to. I don't think. I might cut it into two pieces where we pivoted from mindset and give them the first piece on LPs, and then as a surprise, for showing up and being there and engaging, give them the second piece.
That's
a little later.
Yeah, for sure. I like that idea.
Yeah. So I really do hope to see you next year.
Yes.
And if you're able to make it, I don't know what I'm going to do, but I'm thinking we're going to have to do some kind of car club night, a Thursday night drive, or something. Yeah, we're trying to really concentrate on that networking partnering piece by we got the hotel to agree to give us the discounted rate for 3 days before and 3 days after. We're really hoping people, the reason we're doing it Wednesday, Thursday is we're hoping they'll stay over Friday, Saturday, and Sunday. And we're going to try to do some organized events, let them see Chicago and have some fun, get a tax write-off. Oh, speaking of which, run this by your CPA, but if you want to donate your time then you can send me an invoice for what your time would normally be worth to do a conference, and then donate that back to the GOB network because we are a nonprofit. I think that would be a nice little tax write-off for you. But
So,
you'd want to
sorry,
run it past your CPA.
I've never heard this before. I'm absolutely intrigued. Can you explain that to me again? Because I kind of didn't follow that. I'm going to take notes.
Well,
because-
let's say that I had to pay you 50 grand to show up and speak, and that
Okay.
was the total cost to the GOB network. And then you decided, Jim, I want to donate that 50 grand back to the GOB network.
Meaning that I would send you the cash?
Well, I don't know if we have to physically have that exchange.
Interesting.
That's so I think it can be a paper exchange.
Okay, I'm going to talk to my accountant about it. I've never heard that before. It's fascinating. Thank you for bringing it. Where did you come up with that?
I don't know, Jeremy. I have so many freaking ideas that roll out of my head every day. What I need is someone following me around. I need that Fireflies app to live in my pocket all the time.
Oh yeah. Well, thank you. I just made a note. In fact, it's great timing. I'm going to be speaking to my accountant in the next week or so. So
fantastic. Let me know what they say, what their feedback is.
yeah. By the way, I want to go back to your idea of like Chicago is such a great city to tour, especially in the summer. And I don't need to tell you, between the water tours and everything, like it's such a great city. So getting the bus tour, maybe a double decker, and then also the water tour, like people are really going to enjoy that.
Yeah, that's what we're thinking. We want to do. Some of the things we're thinking is maybe doing the architectural tour on the river, and of course the museum campus is just phenomenal. If people bring their families, and we want them to bring their families, we're encouraging everyone to bring their children, and we're going to try to put together a special educational component for the children. And so I'm thinking of buying, I need to tell my wife to go to all the thrift stores. I want to buy as many, what do they call those, the kids play with? Doll houses. I want her to buy as many doll houses and dollhouse furniture as she can, and little things like that, a Lincoln log set. And I want to start to, I don't know how yet, but I want to kind of play a cash flow game or Monopoly type game, but make it interactive, 3D interactive for them, and to have a little bank and start to teach a little financial literacy.
Have you heard of Robert Kiyosaki? I know you know Cash Flow Game, but have you ever heard of Cash Flow for Kids?
I have, and that's kind of, I think, going to be my model.
Yeah, I mean, you could potentially get a couple of them. The problem is, I haven't checked recently, but I think when I bought mine for my kids, it was years ago. It was out of production for some reason, and I had to go buy on eBay and buy it for a lot of money because there's a low supply. I don't know if they've restarted making them, but it really is a fabulous game. I've used it with my kids for years. So some conferences I've seen will take a cash flow board, have a room, and then have like a nighttime activity of having, figure if the cash flow game is meant for 5 people, a whole bunch of tables of 5 playing the game independently, and you could do the same thing with kids.
Yeah, I'm hoping that if they bring their older kids, that I can get the older kids to kind of mentor. They'll be like the sponsors, and the little kids will be like the LPs or something, or partners that you partnered up with, the experience, less experience, and get all of them involved. Because I know if their parents are in the other room trying to do this, the best gift I could possibly give them, if I knew them for the next 40 years, was for their children and their significant others to fall in love with this and want to do it with them.
Yes.
And
yes.
for the significant others that come that are not really that involved, I'm going to ask them if they would like to, help us with the kids.
Oh, that's a good idea.
Yeah, because even the 16-year-old that's trying to teach the 8-year-old about finances, a mother who's not that interested still knows a lot more about it than the 16-year-old probably does.
Yeah, that's
and she's a lot more comfortable teaching it to kids than she is interacting with the other adults that she may not be as interested in talking to. And that's a way to get them a little more involved.
Yeah, and so along the line, similar topic, which is, do you know Gary Johnston?
Gary Johnson.
Johnston with a T, so Johnston.
Johnston.
Yeah.
I don't think so.
So if you go to GaryJohnston.com, it's funny because he used to be better known, and he's also more known on the West Coast for some reason, but I think he lives in He lives in the Midwest somewhere. Anyway, he's someone who worked at HP, who retired in his late 30s based on real estate, created a bunch of courses. He does an annual like mini conference in Vegas each year with a lot, but he does more like active note and single family investing. He has a course called Principles of Financial Freedom, and he designed it for his kids. I've been to it a couple times. I'm finally taking my 14-year-old to it. It's actually over Labor Day. He does it a few times a year, but it's actually here in like outside of LA in Orange County, Labor Day weekend every year. And I'm hoping finally, because in fact, the irony is that I'm going to be living right near it once I move, hopefully in time for Labor Day to be able to take my kid. It'll be like 10 minutes away. So if you ever are curious, from a kid's perspective, I would say that course is perfectly fine for an adult, but it was created to be very, not like kid easy or kid friendly, but just very thorough. So you need to be at least 12, 13. You need to be able to handle a financial calculator and kind of be able to follow. So if you can't do that, forget it. So it's probably like at a 13, 14-year-old level at least. But yeah. I just want to, if you never heard of it, most people haven't heard of it. If you haven't heard of it, I would recommend it for kids, at the right age.
Yeah, that's a piece that my long-term vision, I want to, as I told you, I want the platform in 40 years to be all things real estate. So I most definitely want to have an online educational piece for the children. And I think where I want to start that, the earliest and the easiest way is to have some type of comic book series. And the reason I believe that is that I think comic books are, the whole idea of a comic book is you've got to be able to say something in a picture, just a chunk. Right. And just, even if it's just vocabulary, just introducing new vocabulary and a new type of superhero versus a new type of villain, and I don't know what it's going to look like, but that the comic book itself, at least one, I set that as a goal for myself this year, to put something out before the end of the year. So if you can think of, if anything comes to you in the middle of the night for a hero or a villain, or a costume, shoot me a text.
All right, I will. That's very interesting. Yeah, it's a very interesting idea.
Yeah, definitely want to do that, and passionate about trying to get it in the hands. Particularly, I mean, this is something we should be teaching to all our kids, but in particular, the kids that are growing up that don't have these opportunities, that don't have parents that want them to learn this, or even knows that it's even out there. Right. You're sometimes a victim of just where you were born and when you were born and who you were born to. And I really hope, we want to build out this content and be able to serve everyone. But I could talk to you for hours about what the vision is and the goals, but it's coming much faster than I expected it to, though.
Oh, great!
Much faster. And by the way, I would love to, if you've got any type of promotional kit, a headshot, or bios or anything like that, I'd love to have that so that we can promote you on the conference and send some of that material out.
I'll send you my headshot and bio.
Thank you, sir.
Yeah, no problem.
So just I know I've probably asked this because I ask it to just about everyone. What was your childhood like? I mean, you were born in Canada. Did you grow up in middle class, upper middle class, a family of entrepreneurs?
Yeah.
How did you? I'm always curious about where somebody started. Yeah. And what the trigger was to cause them to get interested in real estate somewhere down the line.
Yeah. So I'm trying to decide how much is really relevant as far as sharing, but the bottom line is that my grandfather on my mother's side. So let me take a step back. Yeah, I'll explain that. He moved here as an immigrant, literally was a janitor, had nothing, learned real estate by working in these buildings, and then eventually became a flipper, and then eventually graduated up to own several buildings actively himself, non-syndicated, with a partner. He had a 10-story office building and gas station, like just a few properties, right? Just maybe 3 or 4 in Montreal. But I saw the cash flow aspect of this all and that stability and stuff over time. He never really taught me any of it, but I saw it in action. My father was, man, my father passed away when I was 52, but my father was came from a lower class family, didn't have the best education, and was a very sad wannabe entrepreneur. Everything he tried didn't work. I mean, he would come home and literally open his trunk and show me like a pylon cone and say, this is made out of blah, this is going to be the next big thing, like literally out of a movie. And I just knew it was not going to go anywhere. I know it sounds very stereotypical, but it's totally true, right? So interestingly enough, my grandfather, my mom wasn't working, so my grandfather would support my mom and my father because he would never be able to support the family. And it was an interesting dynamic, that I saw. I didn't really know it was normal at the time, but in retrospect, it's kind of interesting that all was happening. But my father, one of the things he tried was becoming a commercial real estate broker. And unfortunately for him, he started a couple of years before the great crash in the 90s, or like the early 90s. And then that just was like, okay, he's done with that. But, I didn't learn anything from him either. But there was that little real estate piece there too. The biggest influence, I say, was my grandfather, both in terms of being conservative, focusing on cash flow. And, I didn't learn from him what real estate could do. I just saw what it was doing. But I learned, unfortunately, no one taught me anything. My grandfather had to deal with his partner that they could never bring any of their kids into the business because one of the partner's kids was a drug addict who was going through a ton of money, right? And so nobody ever sat me down. And I mean, he never even once sat me down and taught me about, oh, this is a building, this is what I do, nothing. So I didn't learn any of it from him, but I kind of saw what it could provide is the best way to describe it.
Learn through osmosis.
Yes.
What do they teach the military in med school? I know they teach this, which is watch one, do one, teach one. And so you were definitely watching one when you were young, and you went through the do one, and now you're going through the teach one.
Yes. Very interesting. I've never even heard that expression before. So that's my background. And I did grow up in Montreal. I was there for several years of work experience after undergrad. And then I moved to the US back in 98. So.
And I know you told me that. Was it the job that brought you to the States?
No, what brought me to the States is that, I grew up in a very unique environment because I was first language English in a province, which is the equivalent of a state, that was mostly French. And I knew that long term, if I wanted to work in the corporate world and I wanted to have a job in English, then my opportunities, I think we all take for granted that when you live in city X in the US and you want a job, you pretty much know that job is going to be in English. But that wasn't the case where I grew up. And that means that if there were 100 jobs posted in a day, maybe 30 or 20 of them were English, and that just limited the scope. It just filtered down so the thought process of am I going to be able to find a job for the next 50 years in this city? I don't know, because I can't do not that I can't, I could, but I didn't want to do 3/4 of the jobs in French, right? So when you're in Canada, there's only a few options. If you want to live in a big city and have a lot of opportunity, it's going to be Montreal, Vancouver, and Toronto. I didn't want to live in Vancouver, and then Toronto was the only option that would have been viable, but I thought the US had much more in the way of opportunity. So when I moved down to the US to do my MBA, it was meant to be a transition to beef up my resume and have the Wharton degree so that it would open doors into well-known companies. Because one of I had a couple of good jobs in Canada, but no one would ever heard of it. I worked for the largest telecom company in Canada, but it was government owned, and you would never heard of it, right? Kind of like Bell, but it wasn't. And you in the US would never know it on my resume. I worked for the largest privately owned computer company in Canada. No way in hell you would know it, right? So if you were in the US and I had those things on my resume, you would know exactly what they were. So I had to kind of build that resume, and I did it through that transition so that opened doors to get me into better known companies in the US. So my goal was to move down permanently by taking that step, right? It was like, how do I get out of the country? That was probably the best transition.
And you worked at Ford and Toyota?
I worked at GM. Well, I did a MBA summer internship at GM.
Okay.
And then that was fascinating, but that was just one summer in Michigan, in Detroit. And then my last corporate job was at Toyota headquarters. I interviewed at Nissan headquarters, Honda headquarters. I was very constrained because I had a foreign visa for most of my work life, and people would have to deal with that and what they call sponsor you. And I was just harder to hire than most people, you know.
And what did you do at Toyota?
So at Toyota, I started off in early '06 in it was in marketing, the next generation of in-vehicle technology. So at the time, it was satellite radio, Bluetooth navigation. Those are the big things back then, okay, the newer tech. And so I was working on stuff that was being released in like '08, '09, '10, as far as like the navigation interface and the in-car tech, right? And actually some of the other stuff, for example, at the time, it was very advanced that we had like a system that they were developing where if you got into a crash, it would automatically call like OnStar, you know, and you'd come and get the ambulance. That was all new at that time, and we were developing that too. After the first year, I then pivoted, moved to a different division. So that was their marketing division. I then moved into financial services. And my last job there was I managed a team of pricing analysts, and we would actually publish weekly pricing and finance rates for, but it was more financial pricing. So rates, you know, lease finance pricing across Toyota, Scion, and Lexus. There were 30 some odd divisions, like they broke the country down 30 different ways, and in terms of who we published the pricing to. So you can have different pricing in LA than you would have in Wisconsin on a given week. You know, it wasn't necessarily universal. So I was responsible for managing a team that was issuing the weekly pricing and making those adjustments and deciding which brands or which exact models had to be, what's the best way to put it, promoted through better rates, for example, or better lease deals or better residuals or whatever it was, depending on how things were selling and all that type of thing. That was only half a year, and then I left. So.
And never look back.
No.
So were you already doing very well with your investing at that point?
Yeah. So, you know, I didn't mention it in earlier, but my goal was not to get out of the corporate world. I wasn't one of those people like, you know, people who come to me today and are like, I want to get out in 8 years. I'm going to invest this much each year as my plan. It's great to have a plan. My goal was to get the paycheck and the cash flow. I just wanted to reconfigure my retirement account into more predictability. So I left the corporate world in '07 because I had enough cash flow built up to live off of, and I had a last straw moment with my manager at the time. So I did well with the cash flow, but I wasn't intending to take the risk of leaving the corporate world. And so I got very lucky because I also had a lot of stuff that was what I call fully amortized. So you're very familiar with an apartment building. You're getting X percent, 7% in year one cash flow, but it's non-amortized to me. You got a big chunk at the end that you're going to get when you sell it. I call fully amortized kind of like as if you were providing someone a mortgage, where you're getting kind of principal and interest together and the cash flows are higher. So similar to the ATMs I invest in today, I did a whole bunch of different things, including like some equipment leasing for a friend of mine. And to give you an idea, he was building up a web hosting company, which was a thing before, like, you know, Amazon AWS, and he would need like tens of servers, right? Because he was building his own server farm basically, and it was meant for private and security for clients. And he came to me and said, here's my lease contract. If you want to match it, you could do it instead. It was like, you know, from a third party leasing, and it was like a 28% interest rate. And so it was like, he was paying me 50% cash on cash for 3 years plus a 5% buyout. So that was an effective rate of 28% roughly at the time. So I did a whole bunch of those and was able to compound them. But also when I left so in other words, it wasn't like I had $1 million invested at 10% and I got 100,000. You could have $1 million invested in that form and be getting 500,000 a year. Now it wasn't all that, but the point is I'd supercharged my cash flow because I had a mix of amortized and non-amortized. And because of that, I was able to get out of the corporate world when that last straw broke, even though that wasn't my intention. And then I very carefully rotated into much more non-amortized over time, because the problem with amortized, if you live off that cash flow, you have nothing at the end. You're eating through your principal and interest at the same time. So that's kind of how my whole thing went. But I had good cash flow, but it was because some of it was fully amortized.
Yeah, interesting, very interesting. And I didn't know that about your background. You know, I know we had shared with each other. We both had a background in automotive, but yeah. I don't think that we shared that. Because I think I would have remembered, because my progression from starting as a salesperson and then progressing up through the sales side, you know, to sales manager, and then after being a sales manager for a period of time, moved into F&I, into the finance and insurance
Yeah.
side of it. And so, yeah, very interesting. And of course, you see that also not just in F&I, but as you progress up to ownership, you see the different people on the other side of the country getting a different deal than you're getting,
Oh, yeah.
or somebody in the big city getting a different deal
Yes.
than you're getting here in the small town. And so, yeah, interesting stuff.
Well, I don't know if I ever told you, but when I worked at GM headquarters, that was, so I worked at headquarters for both companies, right? I wasn't in the field. And my 3-month internship, did I tell you about my internship? I don't know if you remember or not.
I don't think so.
So here's what's so funny. I worked on the Corvette and Camaro brand team, marketing team. And as a perk for being there as an intern from like one of the better schools, they would give you a car the whole summer. And so I literally had either a Camaro or a Corvette at the time. And sometimes, so a lot of them were show cars. They go to the different car shows, or they'd be used for the press. So you'd get a call like 2 p.m. at your desk, and they'd say, listen, you got the red Corvette convertible. We need it. Come. We need it today. You got to drive it back to us and we'll give you another car. And literally you would just show up at this warehouse, about 20 minutes outside of downtown where the headquarters were. And there's just a huge indoor warehouse of cars.
Yeah.
And you give them the keys to this Corvette, and they needed the red one with the white top you had. And then they give you the orange Camaro. They'd be like, okay, these are the cars you could choose. You literally choose one. It was crazy. But but it was so much fun. I was sitting in meetings about the planning for the next generation of the Corvette, and they were looking at the specs of 911 Turbo at the time, and they were looking at what it could do and how many speeds the transmission had and everything else. Way back in '99, and it was very fascinating. I mean, GM was a whole other. There were a lot of issues with the legacy and anyway, but it was a fascinating experience. But I actually had my own. At the time, I had bought a used Dodge Stealth twin turbo, and which was a crazy car at the time. And I had brought that down to Michigan from Montreal for the summer. And on the weekend, I'd wake up and I'd have like a Dodge Stealth twin turbo and a Corvette. I was in this apartment they put me up in, and it was like outdoor, all outdoor. It was like 2-story apartments with a lot of outdoor parking. And I just wake up and like, okay, I was pretty young at the time, mid-20s. I'm like, which car do I take on this Saturday? Yeah. It was a very interesting experience.
Living the life that summer.
Yes, for sure. Yes. Yeah, it was fun.
Yeah, I shared that picture of you that I took when the last dealership that I owned was a Dodge dealership, and I had the Viper, and my kids were still little, and people ask me how I can drive what I drive now, because it means nothing to me. I've had so many nice cars, and I used to be in love with cars, and I still really enjoy, talking about them, looking at them, but owning them anymore. I jokingly tell people that I just bought my latest new car, which is a 2008 Toyota Yaris with 175,000 miles on it. It replaced a 2000 Cadillac Escalade with a couple of 100,000 miles, a busted windshield, and a huge dent in the back door, because I'm just needing to get from A to
point
B.
A to point B. Yeah,
I want all that money going into an investment.
Yes. I know. I'll tell you, the one thing I do though is I have like a 10-year-old car myself right now, but the one thing I do is that you ever looked at Turo?
Yeah.
Okay. So Turo is fascinating because its stuff is so mispriced. Like, so I'm trying to think of a good example. So let's say that you wanted to rent a, I don't know, 2022 Porsche 911 convertible from the typical exotic car place. Okay. You're going to pay probably $800 to $900 here in LA anyway for that car for a day. Okay. And someone's going to fly in off some jet, rent it, and leave. You go on Turo, and there is a lot of them who people have bought to like just rent them out, and you're going to rent one for like $300-400. So there's a lot of different cars that are literally half the price of what you used to have to pay to rent them. And once in a while, as a treat, I'll rent one on like a Saturday afternoon, have it till Sunday afternoon. And I've tried a whole bunch of different cars this way, but it's very cost effective, because when you start looking at cars like that, between depreciation, maintenance, and insurance, right, and all the rest of it, because you can use your own insurance, it's amazing. Like, so that's what I do once in a while to treat myself. And in a city as big as LA, there's interesting selection. There's some crazy cars on there that are completely mispriced. And it floors me that people are willing to hand the keys of those cars to people.
Absolutely.
Yeah.
I don't know how they do that, because for me, if I'm going to invest, 150, 250, 300 grand in a car,
Mhm.
I want to invest in something that I know it's going to depreciate like crazy in the very beginning, but my hope is after 3 years or 4 years or 5 years, it'll stabilize and then start to
Right.
go up again,
Right.
and that if I hold it long enough, it at least I didn't lose money if I didn't drive
Right.
it too much. But
Right.
yeah, and that's I think the only types of cars that I would invest in anymore. And I'd be afraid to drive them. I wouldn't
Yeah,
want
I
to drive
know.
them.
Yeah, I know. Yeah. When the dealership experience you mentioned with the Dodge dealership, the last one with the Viper, was that during the era where they had the Dodge Stealths?
The Stealth we had stopped production. I want to say this last year for the Stealth.
It was 2000 and 2000 and
Well, we stopped production
no,
though.
96. 96 was the last year, I think.
Yeah, but we stopped production in at Dodge, and it went back to Mitsubishi
Oh
only,
yeah, yeah.
and then it picked back up
The
again.
VR, so I actually the first car I got when I moved to LA was actually a VR4, the twin turbo Mitsubishi. That one stopped. That one had some crazy stuff at the end. That crazy wings, a plank wing was the last
Yep.
year.
Yep.
What was the last year of that car? That one I don't remember, but the Stealth, the last year was 96.
I was going to say 98, but I couldn't remember.
No, it's for sure, because I had a 95 or 96, but I'm pretty positive. But
Yeah.
the reason why I ask is because, man, holy crap, was that car a nightmare? If you have to just, I don't know if you remember this. Do you know what it took to change the oil? No, sorry, change the spark plugs. Maybe you had to drop the whole engine to change the spark plugs, and it was like literally $1,000 of labor just to be able to change the spark plugs.
Yeah. Yeah, and there's still things out there like that it baffles my mind. That's one of the reasons I've always thought Toyota, more than any, I think historically did the best job of making those normal maintenance items accessible.
Yeah, yeah. Although, I mean, for an enthusiast like, having worked at Toyota for a year and a half, it was a fascinating Japanese culture, fascinating. But they never really got the enthusiast piece ever. I mean, the LFA is great, but it's inaccessible. It was the one car I could think of, literally. Maybe the old MR2, I don't know, from way back when, and the Supra twin turbo, right? But that was so long ago now. And it's funny, like we're looking at buying a Highlander hybrid for my wife, and we were waiting to see the details of the facelift, and they actually just released them last night, coincidentally, for the 2023. And I'm blown away. Like, in this competitive environment today, Toyota had the balls of like literally not making a single exterior change on the facelift.
No kidding.
And what I understand about them, and the reason why they chose that, is because from a quality perspective, they don't change anything, nothing can break. And I guess they know they don't have to because they're going to sell. So they'll choose. I mean, literally, they didn't change a wheel. They didn't change the tail light. Like, I'm talking about the fit within the normal, fit that it had. Like, you won't be able to tell the difference until you're inside the car. They put in a digital dash where there was no digital dash. They revamped the nav with the new nav software they have. And, but it's unbelievable to me. Like, but they were just always so focused on quality, but they were willing to sacrifice being behind, especially like in the technologies I was working on, the interiors, even the Lexus and stuff. Always a generation behind of everybody, but it was because they just had to have it so tested and quality tested that they could never keep up, because they wouldn't be able to test it satisfactorily to be able to keep up. Like, it was impossible. Tesla being the exact opposite approach, of course.
Yeah.
So,
yeah.
But yeah.
Jeremy, thank you so much. It's always such a pleasure to talk to you. I really appreciate it.
Look, I hope this was helpful for everybody. Thank you for being able to do it this way this year. Hopefully I will see you in person next year.
We're going to cross our fingers.
Yes. Thanks again for having me on. I appreciate it.
All right. Take care.
Okay. Talk to you later.
Bye-bye.
Bye.